Okay, we are thrilled today to be here with some global thought leaders on multi-asset strategies and solutions. We have Alex Schindler, Managing Director, Co-Head of Income Investing for BlackRock's Multi-Asset Strategies and Solutions Group. Alessio DeLongis, Head of Asset Allocation and Senior Portfolio Manager for Invesco Solutions Team. And Barbara Reinhard of Voya, a Senior Manager, Chief Investment Officer, Multi-Strategies and Solutions. Today's discussion will be moderated by Ben Nye, Chief Investment Officer at Narwhal Capital Management. Let's give a warm Atlanta welcome.
Thanks everybody for. That's a little bit better.
I think. There we go. Thanks everybody for coming out here tonight. I was speaking with these people just prior to coming out here, and I was getting more and more excited and thinking to myself, I got to save this question for the panel. So I'm excited to see what they have for us tonight. We're going to be talking a lot about tariffs, obviously. We're going to be talking about the economics and where the economy is going. And what we're going to try to do is disaggregate those a little bit and then combine them. So we're going to talk a little bit about tariffs, then talk about the economy, and then talk about how the tariffs impact the economy. I know it's difficult to disaggregate them sometimes, but that's what we're going to try to do. And then we're going to talk about what that means for various markets. I know Alessio has a lot of experience in currencies and flows, and Barbara's extremely macro aware. And then Alex has a lot of expertise on the income side. So I think we really cover many of the buckets that we need to cover here in a multi-asset panel. And so I guess we're just going to jump straight into it. And the first question that I have, and this is really a panel question, and I'll start with Alessio here, and that is, where do you see the path forward on tariffs? I think that some view it as a negotiating tactic, some view it as permanent. But when we're here maybe 6 months, 9 months, 12 months from now, how do you see the process having evolved over that period of time?
Thank you for having me. Good to see you all. So that's a loaded question, especially when you think about what Liberation Day brought was basically a really confrontational stance against 200 countries around the world, including those inhabited by penguins. So to answer your question in a straight manner, I think it's going to be a highly volatile and unpredictable headline environment for the very reason that in some cases these are simply negotiating tactics that have nothing to do with trade. I think that's very much true with Canada and Mexico, because this is the administration that restructured the NAFTA and created the USMCA. What is it that you disagree with? So there, it is probably a negotiating politics and a negotiating tactic around other things, be it fentanyl, be it whatever that is. A lot of it is headline grabbing. So there, you can see some de-escalation. But when you start talking about China, Asia more broadly, where there is broader economic considerations involved, strategic, rightly so, strategic national security considerations, I think it's a lot more complicated, and I think de-escalation from 145% tariff headline is very likely, but you're not going back to 10. You see, and the other one that I see also very challenging, where I see a big ideology difference with respect to trade practices, is with Europe, right? The US has long wanted to export more food to Europe, but Europe has certain health standards that don't apply. Agricultural products more broadly, concerns around data privacy and protection around big tech. So there, what the US wants to export to Europe, there's a big gap there. So the path I think this trend of this pressure, no, we're talking about it more later, but this pressure of dollar depreciation as kind of like one path to clearing prices seems to be the path of least resistance one way or the other.
So let's do kind of almost a two-part rationale for some of these tariffs. One that can be mitigated relatively easily as a negotiating tactic, and the other that's going to be a lot more difficult to really nail down and de-escalate.
Yeah, and my additional comment on this is that the way the administration, and we know that there was a last-minute compromise, but the way the administration published their basically plan to have a zero trade balance with anybody around the world, that logic, as we all know, is extremely flawed, has backfired. I think it's part of the reason why they had to go back to a 90-day pause, because they realized that the communication, the economic justification for the way they went about the tariffs was completely flawed and undermining their own agendas. But we have seen, everybody knows here probably the paper from Stephen Miran, who is an economic advisor to the administration. There is a big component of ideology here, right? There is a part of the advisors to the administration that truly believe that being the reserve currency of the world is not a privilege, but it is actually a cost, and there's structural dollar overvaluation that comes with it. I don't agree with any one of those arguments, but if that's what they believe, I think the negotiations are going to be pretty tough, because you're coming from polar opposite ideological prospects with respect to this resolution.
It's an interesting perspective. I know Scott Bessent has talked about no one creating leverage more than Trump in negotiating. So Barbara, I'm going to go to this with you, because I know before you had talked about really using these as a negotiating tactic. And so how do you agree maybe with Alessio's characterization of things? And then how might you say the administration might be flexible in coming to an agreement?
Well, they've already been flexible, and not once, not twice, but 3 times. So, the administration clearly has realized that they're negotiating against themselves at this point. So they backed down. I guess the worry that I would have is that, the China hawks in the administration are now taking over, and Trump is finding himself in an untenable position that he can't back down from. But he's got advisors that are just going to keep on putting this agenda, right? So I think, how does this look, 3-6 months from now? There may be, past, the July 9th date, that that'll be, rolled out another 60 days because we're printing deals. I mean, we can't print a deal with Japan, one of our longest and most ardent neighbors and, brothers in arms. So I think the administration has to start to get very clear about what it is that they want. Japan already came in, or I think it was Europe came in and said, we'll do 0 tariffs. And they're like, well, that's not good enough. Why not, right? So I think that the administration is closing the ranks. Clearly, you're not hearing as much from Navarro. He's been kind of silenced and sidelines. Letnick keeps on popping his head up a little bit. But this really comes down to, I think, Jamison Greer and Scott Bessent. Those are the 2 people that are negotiating these. And I feel like that is very level-headed at this point. It's very nice that they say that it's Donald Trump's negotiation, but those are the people that are flying to Switzerland, not Trump. So the market is telling us that this is a negotiating tactic, and at least for the near term, I would probably agree with that.
It certainly has an impact on fixed income markets, Alex. I'm sure you were paying attention to that at 2 a.m. that day, where all of a sudden bonds were selling off like crazy. I remember I did not get much sleep that night. I imagine you didn't either. So talk to us about how you're thinking about fixed income in light of these, because it's fixed income really shows a lot of the flows and just the supply and demand, especially as it relates to international demand for U.S. bonds. How are you seeing the current tariff on again, off again, demonstrate in fixed income markets.
So again, same thing, echoing, thanks very much for having us here. Sometimes when you're chatting with people out there in the world, like, what are we going to talk about? You know, is anything going on? Obviously not an issue today, right? Not a problem. The problem is how do we fit even just what we've been talking about so far? We could go on, have a robust debate with all of you and ourselves for hours. I'd make a couple of points as background, and then I'll touch on the element of fixed income specifically. The first one is, how do you, why do people use tariffs at all? And there's multiple reasons to use them, and the current administration has talked about each of those different reasons at different times, and sometimes at the same time. And that's making it hard to figure out exactly what we're going to look like 3, 6, 9 months from now. You can use it to raise revenue. And that's an underappreciated element of this, in my judgment, that I'll get to in a second. You can use it to try to get to freer trade down the road by starting with tariffs, and then you agree to unwind them and you get to better trade. Or you can use it for non-trade related reasons. And as Barbara mentioned, sometimes some of the thought processes with some of the countries are actually not related to trade at all. They're related to either non-tariff barriers for trade, or they're related to something completely different. Maybe like funding the US deficit by asking people to buy bonds in exchange for no tariffs. So when all three of these different reasons to use tariffs are in play, it can be hard to figure out for market participants, and frankly for the administration itself, at least portions of it, what we've heard, of what is the goal here, what are we trying to accomplish? And we know from press reports that other countries are struggling to figure out who they should talk to and what they should offer them, whether it's no tariffs or something else. I mean, South Korea and the US already have a free trade agreement that covers almost everything. So what exactly are they supposed to offer? I think in that case, they're probably supposed to offer payments for US troops. Now, having US troops in South Korea gives the US knowledge of a North Korean missile launch in 7 seconds instead of 15 minutes if they were only having to use Alaska. I personally think that's very, very valuable. And I am totally okay with no tariffs in order to get a 15-minute head start on whether or not North Korea has launched something or not. In the first Trump administration, that was not seen as a popular or valuable thing, but it's unclear for this time. So that's the first thing that I think is a bit of a struggle for what things are going to look like. The second point is that I do think the market consensus is, and seems reasonable, that we'll end up with a 10% universal tariff, plus not much else on the non-China countries, plus something lower on China. The chatter in the last couple of weeks has been it's definitely going back to 50 or 60% immediately, but down the road it's going to be lower. If we just started with that from nowhere, that would be a huge impact on the US economy and a huge impact globally. It's only because we got the billboard tariffs in the middle that it now feels like, oh, that's back to not that big a deal. And so I think that when we get to it, the puzzle will be what's the actual impact of this going to be. With respect to fixed income and with respect to revenue, these are tied in together. So the 2 points here are, one, that part of the administration's desire to talk about lots of tariffs is because they have told conservative members of the House that they're going to get $2 trillion in revenue from tariffs, so it's okay to vote for deficits in other parts of the budget. And that trade-off means that until they get that reconciliation bill done, it's going to be very hard for them to walk back tariffs completely because they need that promise of future revenue. They don't necessarily need the actual future revenue, but that's a different element of things. And then the second part is that the counterbalance to trade deficits is people that are net getting US dollars from US spending money in that country. They're recycling it into buying US treasuries. And if they don't have that net trade balance anymore, in the way that the billboard tariffs were gonna get you, well then they have no need for US treasuries. So who's gonna buy the US treasuries? Well, we are. But if we buy US treasuries, what are we not gonna buy instead? So that whole puzzle, which is also linked to how much of a deficit there's gonna be and how much supply of treasuries are gonna be, I think is gonna be a key part of 3, 6, 9 months down the road.
Another way of addressing this has been currency devaluation. I know I follow a lot of equities, and routinely it's about 1 to 2% of revenue is a lot of a hit for a lot of these companies. Whether you're talking about Ford, whether you're talking about GM, whether you're talking about a company that reported just today, an HVAC company called Johnson Controls. And I know, Alessio, you've put a lot of work into this and looking at this kind of dollar devaluation piece as a result of tariffs. So if you could talk about that a little bit and expand on that.
So I actually, that's exactly the space where I started my career, focused the first decade of my career. I started in this industry, believe it or not, building models to model the entire balance of payments of the United States. And here's the problem with what the expectations are around these levers, whether it's tariffs or currency depreciation on the trade deficit of the US. They don't matter. These are the facts. These are the empirical data. The number one driver of the United States trade deficit with the rest of the world, even ahead of or actually related to structurally to the currency reserve status, is what is called the income differential. Meaning the United States has a propensity to spend 1.5 for every dollar that they earn. As income grows by $1, they will import 1.5. Conversely, the rest of the world, so foreign demand, so exports for the US, the rest of the world, for every $1 growth in their GDP, they will import 0.8. So again, this goes hand in hand with the currency reserve status. By definition, you need to build up debt. In other words, you have a higher propensity to spend than the rest of the world. That is, by and large, the biggest driver of the deficit. Now, let's put in context the currency devaluation. So tariffs, when you put on a tariff, you saw this in 2018, in 2019. When you announce a tariff clean, the argument was the tariff is immediately unwound by the immediate currency depreciation on the foreign currencies on which you impose the tariff, so it nullifies the impact right away. From a market dynamic standpoint, the revenue question is, of course, there. Like, money is fungible. What do you do with that money is a different story. Let me give you an example about the minimal impact that how big currency movements have to be to make a dent in the trade deficit. Back in 2007, 2008, the trade deficit of the US was negative 6%. Today is negative 3.5%, negative 4%, the current account deficit, okay? So it was about twice as large before the beginning of the GFC. The euro was at 140. The euro was at 150. So you had a much, much weaker dollar than today. The yen was at 100. And the current account deficit was much, much wider. So again, it goes back to this income differential argument. You want to close the trade deficit, you need the rest of the world to grow a lot more, or the US to slow down a lot more. Everything else is nice attempts, but it's not going to fix it. So my concern, going back to the negotiations, is that I do hope that the negotiations are about something else, like among all the arguments that you just listed. Because if you really sit at the table and try to go down the list of the things that you can do and expect to see a change in the trade deficit, you're not going to see that.
Barbara, as you think about it, you painted a good picture about what could happen with tariffs going forward. If we think about it over the next 2, 3, 4 years, what are people looking for? I mean, what do the consumers, what do investors have to look forward to? Is it going to be this escalate, de-escalate cycle for the next 4 years, or do you think we're going to reach a status where a status quo? And if so, what does that look like? Is it multipolar world? Is it a flat rate of tariffs, like Alex was saying? The 10% globally. How does that look like to you?
Well, it's going to be. I can tell you this, it's likely to be more inflationary, and then it'll be disinflationary. So inflationary because, dollar falling by definition will be more inflationary at the margin. And as you can see with the front running of a lot of consumption, just even over the past quarter, that also is inflationary. So right now you've got core PCE running at 3.5%, right? I was reading a study earlier today that was talking for every 1% in tariffs, or the tariffs in general should probably add another 2.25% on top of core PCE. So now you're talking about core PCE running something close to 6, right? That is a big number. And if you think the bond market started to lose its composure on April 7th, like, you wait and see, right? That's not going to be pretty. So, but that's a very short-term phenomenon. Longer term, tariffs act like a tax on consumption, and a tax on consumption will lead to less consumption. Even with Americans consuming 1.5 for every dollar that they earn, it is likely to be very inflationary. And with that, I kind of hark back to other periods that have been inflationary in the US. And what happens is, if you go back, all you have to do is go back to 1979 with Jimmy Carter, or 1970 with Richard Nixon. Like, the party that is in office that causes a lot of inflation generally gets voted out, right? And the problem also becomes that when you have inflation, you also tend to have multiple compression. But it's a sequencing of event things. So look, I think over the near term, it could be that the inflation starts getting hotter before the economy cools because of the increase in prices. That could be somewhat problematic for poor Jerome Powell, right? What does that mean on a 3 to 4 year look? I think the issue becomes that the U.S. is I hate to say it's becoming uninvestable, because that's what China was like 3 years ago, and the market just got hammered. I don't think the U.S. is uninvestable, but it's on the global scale, it would mean the U.S. is a more unreliable partner. Remember, part of the exchange has always been, you will export all these goods to the U.S., you will buy U.S. treasuries, and we will have troops sitting on your border for you, right? Like, that's the big agreement with most small Asian nations for a long time. So that becomes, much more, I don't know if it's multipolar, but I think that the U.S. has done some pretty big damage to having this reserve currency. I don't know another one that is deep and is liquid that could be the reserve currency. Like, is it going to be Sing dollar? Is it going to be the euro? I'm not so sure. But I would say it'll be inflationary followed by disinflationary, and if tariffs stay high enough, it will become deflationary, which is very bad. But that's not our base case scenario at this point. But there'll be unintended consequences to it. I mean, look, Taiwanese dollar was up over 6.5% in 2 days. Like, there's going to be second-order knock-on effects that you have to think very creatively about in this environment.
Alex, you had
Yeah, I just add a couple of things real quick, or quickish. One, I forgot to mention the sector tariffs, which relate to this idea of there's strategic elements to the U.S.-China relationship that don't have to do with the trade deficit, they have to do with strategic interests. And so it'll be interesting to see what we get out of those, because those, I think, like the 10% universal, will be harder to take off. The second point would be, I think of this whole situation as you're riding a bike and you take a stick and you stick it in the spokes of the front wheel, okay, and then you fall over. So you did it to yourself. The question is, how fast were you riding? How injured are you when you pick yourself up? And when are you going to take the spoke out and get back on the bike? And I think that's a puzzle that we all as market participants are struggling with, because there hasn't been a situation where you just had like a regular growth slowdown in decades. That's turned into a recession in decades. It always comes with some kind of financial crisis, because the way the economy works today just isn't like that. And what we've seen so far is essentially U.S. consumers deciding they're going to buy a little bit more because they're worried about prices going up, not buy a little bit less because they're worried about losing their jobs. And I think if you talk to a lot of market participants in February, they would have said, that's for March. By April, we're already going to have people pulling back and worrying. And the April data has come in, and that's just not true. Even the stories about the ports slowing down are a little bit questionable. The data is not totally clear anymore. It may be that actually stuff's picked back up. Jaguar started shipping again after holding off for 3 weeks. I'm not saying Jaguar is a huge part of the U.S. Economy, but it's an anecdote about a company that literally paused all their ships. The last thing I wanted to say is just in relation to what you were talking about for the dollar. This whole element of being a reserve currency is about being the place that people feel good about. And that has given the U.S. a ton. It's given the U.S. the ability to borrow money to do the spending at a lower price than they otherwise would have. Normally, if you had the characteristics of the United States economy, you didn't say what was the name of the country, you would have to pay a lot more for your debt. But because you're the reserve currency, because you're the reserve instrument, the risk-free instrument, that's been a huge advantage. The disadvantages that have come from that have been a hollowing out of the manufacturing base, as well as a lot more financial elements to the economy. Capital markets here are way deeper, which is good and bad, than they are in Europe. And that's led to more income inequality. And so parts of the administration are trying to solve for those elements, the hollowing out of the base, as well as the income inequality, through tariffs, even though that isn't necessarily the way that we got to that point. And I definitely feel like, to go back to your original question, the pressure release valve for all this is the currency. We know this from Japan, because we've seen in Japan that it's much easier for the administration to freeze the level of rates. So left to their own devices, rates might freak out, but you can imagine a post-May 2026 world with a new Fed chair, where all kinds of things might be in play from a US administration's point of view, both carrot and stick-wise, on the level of rates. The current president has stated explicitly he's a low interest rate kind of guy. The Treasury Secretary has stated explicitly that one of his goals is to have lower interest rates. You can force that in a lot of ways, but when you do that, the pressure release valve is the currency. And that's where that trade-off of, are you going to end up with countries that don't feel the same way, plus the potential impact on rates, that's where you end up with potentially big moves.
That's a great point about, well, all your points were great there, but I was also picked up on the Jaguar point. And because I did see some information about even ships coming out of China.
I thought you were going to say you were looking at the Jaguar website, Ben.
Oh, no. I'm waiting for currency to appreciate there. Yeah. But Barbara, I think it brings up an interesting point, because Fed Chairman Jay Powell came out and spoke today, and he said, I don't know a whole lot. And when I'm talking to clients, I can't really say I don't know about when things are going to happen. Yes, there's a lot of risk around, but they hear people like us talk about the risk and uncertainty all the time, but they want to know what's going to happen and how they should react, and they don't want to jump to one conclusion or another. So when you're thinking about this, what are the trigger points that you're watching in terms of, you said there's going to be potentially inflation and then disinflation. What are some of those pivot points, those key indicators that you're paying attention to that would signal, okay, now it's happening, now I need to react?
So when we're investing for our portfolios, we always think in probabilities, right? Nobody knows any specific outcome with certain, so we kind of put weighted probabilities on things. We kind of go through the scenarios of inflation. So we have like 5 different scenarios. Bad recession, garden variety recession, inflation, disinflation, bond market loses control, freaks out. And we put probabilities around there, and we update them every month after we get all of the data. If I had to tell you one thing that I would watch really closely, it would be the JOLTS data, right? JOLTS data, it comes out every single Thursday. It's the claims data. So, the labor market is what determines if you're going into a technical recession, which is 2 quarters of negative growth like you had in 2018 and again in 2022, or you go into an NBER defined recession, which is like people start losing jobs, right? That's the big one. I think in terms of thinking about the profile of the U.S. economy, look, it is very geared towards small businesses, and small businesses are going to struggle in this type of an environment. Just because so many small businesses are sourcing goods from China, right? There was an article in the journal about this just today. So, I watch that data pretty closely, because I think that's going to tell you if you're going to tip for 2 quarters of negative growth. And the difference between those two is like 2 quarters of negative growth, technical recession. Those are peak to trough drawdowns of about 20%, kind of what we just had. Recessions tend to be a little bit more drawn out, right? You tend to have peak to trough declines that happen over a 1-year period, and they tend to be something closer to 35%. So the difference between a recession and non-recession is a really big deal, and the only data that I would look at specifically for that is the claims data. Additionally, of course, we have a lot of natural language processing that talks about, we look for things in corporate earnings and speak in terms of like demand destruction, slowdown, layoffs, firings. Like we scour them for words, like just to kind of get a sentiment indicator on corporate America. The fact is everyone's pulling their guidance at this point, so there isn't all that much you can do with it at that point. But that's another really important one because you can look at all the economic data you want, but profits really drives the whole story.
That's excellent. I appreciate that color. As we look into the overall economy, maybe Alessio, we'll start with you here, and not just the U.S. economy, but then the global economy, because the U.S. has underperformed so many other markets. There's been so much focus on other economies, and other countries and entities are doing some really interesting things. I mean, we've seen what Germany's doing now. But as you kind of look around the world, do you think that this, what we've seen over the last 15 years, which is U.S. producing, certainly outgrowing Europe pretty substantially, and also Japan, do you think that any of that changes? And then maybe if you can touch on China briefly and how this might impact China from an economic growth perspective.
So I think this goes indirectly to the question of U.S. exceptionalism, and I think there it's really, really important to make a distinction between the economies and markets. And on that front, I think from a whole series of structural reasons, the probability of the rest of the world, the rest of the developed world, namely Eurozone, Japan, UK, in aggregate to achieve higher growth rates in the US is very, very difficult. The amount of rigidities, terrible demographic profile, it's just very difficult to see a path for sustained economic growth outperformance as of today. With that said, this is the difference with markets. Markets are a forward-looking discounting mechanism, and everything that I said is no news, right? It's reflected in the valuations, it's reflected in 15 years of disastrous relative performance for, you pick it, EFA versus US equities, EM versus US equities. But it's what valuations are about. So I think there's two things that are changing that we think may have legs, but they require catalysts, very much like what Barbara mentioned. Compared to even just 4 months ago, the amount of fiscal stimulus that Europe is going to do for defense spending was nowhere near imaginable. But more than that, I think it's a signal more broadly also for non-defense spending. Basically, given the geopolitical landscape, Europe is going to be very loose about the Maastricht criteria and allow for far more fiscal impulse than what has been priced in the markets for the last 15 years, right? Part of the US exceptionalism story was also the mirror image of a European debt crisis, right? Let's not forget that. I think there is an unwind of that taking place. And I lost it. So, catalyst. The other things that are changing. Obviously, this dollar story is very important. Basically, you're entering this new phase where you have the currency differential between the US and the rest of the world is easily a 20% differential just to get foreign currencies to fair value, and currencies tend to overshoot, as per the conversation we just had. On the local equity side, obviously very depressed valuations, both for EFA and emerging markets. So I think there is really much the potential there. One catalyst that we've seen, and Barbara was alluding to it, we have seen for the first time in a while earnings revisions coming down in the global downshift in earnings revisions is for the first time in a long time led by the US. US earnings revisions are coming down much faster than what we're seeing in the rest of the world. And remember, revisions is about the rate of change. But we're talking about a level of earnings expectation in the US that is much higher. I would also bring out another topic that is, to me, a very important catalyst that we all forgot about. That's how quickly we move to the next topic. What happened in late January with DeepSeek, let's not forget that, because when we talk about US equities, it's really about US mega cap tech. It's really US growth equities and the top heavy names. The justification for ever rising valuations on US growth stocks depended crucially on the hypothesis that the US, or the thesis that US holds a nearly monopolistic condition in AI R&D. DeepSeek put a dent into that argument. Challenge now, I'm not an AI expert, I'm not a technology expert, I'm not here to make that case, but the market got tested there, right? What you're seeing for US equities is a very anomalous behavior, where in the downturn, value outperforms quality. That's unusual. So what we're seeing today is that some valuation considerations are being unwound and they're dominating over a cyclical picture. Right? So I think that's one big catalyst that in my mind, with respect to asset behavior, is going to probably dominate over some of the more minute economic differentials, growth differentials, inflation differentials, very reminiscent to what we saw after 2000 with the NASDAQ pop.
That's interesting. So if I parse what you're saying, is that the better place to be is a focus on value and valuation versus even region. Is that fair to say?
Our approach to this potential economic transition is one where, much like what happened after 2000, is not only the relative cyclical considerations that are going to drive those asset class implications. And again, the argument being, we can see a situation where the rest of the world continues to underperform from a growth standpoint, the US economy, but yet you have a reversal in the relative performance between the two equity markets.
Interesting. Barbara, I know previously you mentioned you're not going to say it, but that U.S. is uninvestable, but it's something worth considering. So elaborate a little bit on that, and maybe expound on a couple of Alessio's points.
Yeah, I think, look, the U.S. peaked at something like almost close to 70% or 65% of the MSCI All Country World Index. Interestingly, Japan was close to that in 1989. It's a terrible. It's a word, maybe peaked at like 70% of EFA. It's a horrible analogy. I wouldn't want to make that one too much. But I do think that the U.S. Yes, the U.S. benefited at the hand of the European debt crisis, but you have to remember the U.S. has a couple of really good things going for it as well, right? Flexible labor markets, right? Friendly shareholder practices, and as it goes towards the emerging markets, rule of law, right? Those things do make the U.S. exceptional, right? And I don't think that you find that in many other markets. I wouldn't necessarily give up on the U.S. during drawdowns. High beta U.S. always goes down the most. Rest of world always usually tends to hold up better than the U.S. does, right? So if the U.S. is down 20, EFA is probably down something, closer to 15, maybe even 16 at that point. So when you go international, you look like a genius, right? I don't think that the U.S. is uninvestable. I think that the geopolitical tensions, though, are going to flare up, where the incremental sovereign wealth fund manager may say, like, do I have to put an incremental dollar into the U.S.? Can I just spread it around to another basket instead? And that's a consideration which would just continue to hasten this dollar downward trend. But look, the administration, why Scott Bessent says, like, we have a strong dollar policy, no one believes him because Trump's like, I want a weaker dollar, right? So, I think you have to think of it this way. The U.S. is going through this this turmoil at this point. U.S. that has been here before, will probably be here again under different types of circumstances. I wouldn't necessarily throw the U.S. out. I wouldn't throw the baby out with the bathwater for the U.S. at this point. Valuations are expensive, sure, but there are great places to hide in the U.S., right? Like utilities are a great place. They're trading at 17 times earnings with a 5% dividend yield. Why wouldn't I do that? Alex will talk to you all about income strategies. So I wouldn't necessarily say that defense spending in Europe and why they're going to be loosening their fiscal belt is defense spending going to make Europe grow faster than the U.S., right? I'm not so sure about that. So I don't think it becomes uninvestable because we have election cycles, like people don't stay in office forever, right? The issue that you had in China was that like you have an elected official who is in for life, right? Like this could go on for 25 years. This will not, right? So I don't think that it was like a Twitter feed today that says like the U.S. is becoming uninvestable. I think it'll become questionable what reliance you can defend on militarily for the U.S., but I don't think it becomes uninvestable.
Alex, how has this changed your approach to income markets and maybe talk globally, regionally?
I think that in addition to the point about distinguishing between markets and economies, the other really important consideration here is distinguish between asset classes, because the answer for investors is going to be different for different asset classes, and we're treating them differently as we look at what to do in our portfolios for our clients. The fundamentally, or not fundamentally, but ultimately, the price of things in the short term comes down to supply and demand. And the supply and demand picture changes differently for different asset classes in the current environment. So that manager that you were talking about that maybe doesn't put the incremental dollar into the US, they're definitely not going to put the incremental dollar into US debt, right? It's one thing to say that the US is a big part of the equity market. You can potentially wrap your head around the idea that that's because it has the companies that have the most dynamism, et cetera. The history isn't great if you're a huge percentage of the world market, but let's all hope for everybody's career's sake that we're not in a 1989 Japan scenario. Do not go look at the chart of what Japan looks like from 1990 onwards in equities. But from the point of view of debt, if I tell you that, hey, there's a part of the market that's going to have more and more debt, want to buy more? Like, that's not normally the way things work. And also, forget about the people who are in the investors, people who maybe are doing all the work and understanding things. Just consider their clients, their board. You're a Norwegian pension fund. You maybe understand the dynamics at play here, the negotiating tactics of the U.S. administration. But if you're that CIO's employee representative on the board, and you just heard a U.S. administration person say really not nice things about your country, you don't care about the economics of it. There's just a more pressure on not necessarily playing in that sandbox. And one thing that I do think we picked up on from our clients outside the US is that people take the US administration much more seriously word for word outside the US than they do in the US. So in the US, we don't tend to care if the US president makes a comment about a country being the 51st state or Europe sucks or things like that. Whereas in those countries, they really take it personally, right? And that leads to maybe non-economic behaviors that determine supply and demand, but it does matter for supply and demand. From the point of view of an income investor, man, what a great time. There is so much more going on. There's been some awesome opportunities. It's hard to reconcile the chaos of headline bingo with, hey, there's some things that get mispriced, there's some interesting things to do. I think some of the points you've been making about let's isolate the actual change and find ways to capture the potential returns from that make a ton of sense to us. So German fiscal, you don't just allocate to everything that happens to have a stock that trades in Europe. That might be a luxury goods company that is only focused on Chinese demand. It just happens to be in Europe. Find the places where you're actually going to benefit from extra spending in Germany. Or whatever the particular theme might be, and there's plenty of them. That's where I think the exciting part to this comes. And I try to remind myself of that when the headline bingo happens again and we get to a little more volatility.
Yeah, that's. Is there any particular region that most intrigues you right now in terms of investing in those income markets?
I don't think it's a region as much as what Alessio said, which is these big changes in behaviors that have been pretty persistent for a long time. So Europe being okay with running deficits. That the complaint for years was that Germany wasn't willing to do that. That switched on a dime. And there's other opportunities in different, not so much, again, regions, but new themes about the defense area with respect to the rest of the world needing to feel like they're spending more, either for negotiation purposes for exports with the US or just because they feel less comfortable. With respect to AI, maybe it's not about a few companies and training big models. Maybe it's about us all using it a lot more. And as we use it a lot more, there's a bunch of needs that come out of that aren't necessarily related to those one or two companies. Instead, it's related to utilities. Or it's related to the companies that help put the cooling systems into a data center, et cetera. And those are the kinds of themes that are maybe not region or macro specific, but they're ways that, especially in actively managed strategies, you can really extract some exciting returns.
That's excellent information. We talked a little bit about flows, and Alex spoke to not investing the incremental dollar maybe in the United States. So talk a little bit about how that impacts the currency, Alessio, and especially in the short term, because we've seen some pretty radical currency movements. I mean, Barbara made the point about Taiwan just earlier this week. So talk a little bit about how those type of flows impact currency movements and whether or not sometimes we should read into them as a beginning of a trend, and other times this is noise. So separate that noise from signal, because I admit sometimes that's difficult for me to do.
Yeah, the challenge with flows is that they're, first of all, published with a lag, and you really should use flows, especially big balance of payments, capital flows, to understand the story ex post, right? I want to stress this point. The price tells you everything you need to know about the flows that went through, and also those that didn't. Order flow is even more important than realized flow, right? The whole concept around the relationship, the idea of the reserve currency status and how those flows affect the price of the dollar, the evidence in the data is one where you can see very clearly that the number one driver of dollar long-term cycles, so we're talking the 3, the 5, the 10-year performance. So the dollar, for those who are not familiar with, you can take any major dollar pair, and you will see very clearly currencies have about a 7 to 12-year peak to trough cycles, right? Think about the bottom in the euro in 2000, the peak in the euro in 2011, the bottom in the euro back in 2022, and the big currency cycles. You can pick them on all the major G10 currencies. What correlates the most with those cyclical trends is actually private flows, not reserve manager flows. If you take the balance of payments of the US, the capital account, you can look at the TIC data, the TIC data from the Treasury, published on a monthly basis. There are some biases, there are some problems, but by and large is the best we can get. And you can see very clearly that if you focus only on the private flows, namely private Treasury flows, corporate bonds, and equity flows, and FDI, you get about an 80% correlation, statistical significance, with the price being coincident or leading even, right? In other words, reserve managers also, remember how many years have we worried about the day that China will sell? China is imploding, right? China is underperforming. They'll need to sell treasuries. That's going to be the disaster for the treasury market. China reduced their treasury holdings by $1 trillion, and yields didn't move, right? Reserve managers, what is the distinction between private flows and public flows? Private flows, we're in it for a profit. we care about the price, and we are seeking a profit. We want to drive that currency move. Public flows are there for policy management purposes. They don't need to generate a profit. So they're actually more contrarian flows, right? Because they have to buy, they will buy after something has sold off. And there is a very natural argument there. So where am I going with this long introduction? Is that this whole idea about the loss of the reserve currency status, what we've seen priced in the last month or so, is really hedge funds, real money, profit-seeking players that have just front-run a theme, got 10% out of it in one quarter, which is more like a yearly type of currency swing, is not really the reserve managers, right? The reserve managers are not there to drive the price of the currency.
Very interesting. The piping of the currency markets I find fascinating. Switching gears perhaps to you, Alex. When we're talking about what feedback you're receiving from clients and what clients are looking for, and we're going to switch to audience Q&A here in a second. So get your questions in your mind. But what are those clients looking for that you can supply them now on the income side that maybe you couldn't 2 or 3 years ago?
Yeah, just on the point about the timing, the short-term timing of the dollar, I think the weak dollar story was the cover of The Economist 2 weeks in a row. That is not a good short-term indicator for continued dollar weakness. So I would say like the biggest surprise to me since the election is actually how quickly the dollar got weak. I thought it was going to be strong first, and then that would be a 2026, 2027 conversation. And I totally agree, by the way, what we've seen from clients is the slower moving, bigger, again, private participants, but bigger ones are having conversations. They're not the ones doing the flows. Those are much more the sort of faster money, trying to take advantage, etc. The clients want to know whether or not the tariffs are really going to impact the U.S. economy in the U.S. and then outside the U.S. Because the collection of strategies that I manage, we have them in the U.S. as well as outside the U.S. We have clients in Asia and Europe as well. They're much more interested in what's going on with the administration and what is it actually trying to accomplish, what are its goals, etc. In the US, it's much more, is this actually going to turn into something that is really impactful, and or are there any opportunities for me? I think one thing that we have seen is an increase in interest in the non-AI parts of the US equity market, which is something that we have argued for a while. So it's a little bit of price movements causing the client to maybe come to us for that question. But I do feel that people are increasingly interested in a broader way to get their equity returns rather than focusing on just a few stocks. So that's probably the biggest thing.
And I want to stress this is a very welcome development. Where we spent the last 2 years complaining about, unless you own those magnificent 7 to the same degree that the index does, you're doomed to underperform, and it created massive distortions. I really want to stress that this is really a welcome development. If you look at the data in the period between mid-2023, after the NVIDIA call that opened up the market, right, May 2023, the earnings call from NVIDIA, between that period and up to December of 2024, you had gone into such a polarized US equity market where the beta of small caps, or particularly small cap value, became negative to the S&P 500. So let's digest that for a second, right? Small cap value, the most cyclical part of the US equity market, typically under any other time period and market conditions, a high beta. simply because of the capital structure, a much more levered segment of the market, dependent on external funding needs, so on and so forth, more levered to the economic cycle. The market became so obsessed with just trading the AI theme that all of that bullishness was funded from the other parts of the equity market. Now now we're seeing that renormalization, and the breakdown in correlations that we saw was quite powerful, and really we saw the impact of that on portfolio construction. It coincided also with the breakdown in correlation between stocks and bonds that went to positive. I want to stress the point that you made, that it is an extremely good development for all of us asset allocators.
Barbara, you mentioned utilities earlier, and as part of this kind of broadening out theme, both with asset allocations as well as within asset classes, I mean, utilities speaks to that. Perhaps maybe elaborate a little bit on what sectors of, specifically in equity markets, maybe are most interesting here, but then even on a factor exposure, how you're thinking about things.
So, as part of the run-up that Alessio was talking about, the momentum, look at the momentum indexes were just going out of control to the upside. My fear is that you're now starting to see, not to the same degree, but to the same type of direction, crowding in low vol, right? So unfortunately, when markets get emotional like this, they tend to swing from one pendulum to the other, right? So they're going right from momentum over to low vol with like not even stopping in between. It's kind of like value had 5 seconds in the sun and that was pretty much it for over here. So I would just be very careful about factor investing in this type of environment, just because it seems as though that pendulum's now swung so far to the other side, especially when it comes to low vol. I don't think momentum necessarily comes back. I mean, it was the largest momentum run-up out of all the big momentum rallies that we've seen ever. So it just speaks to a lot of air still has to come out of that bubble. I think the second piece, though, when you're thinking about it, you have to, so we always think about when you need to be defensive, you stay in the shuts. The staples, utilities, healthcare, telecom, right? The healthcare's had some issues just because of potential sectoral tariff pricing, so on and so forth. But you just have to look at the line of cyclicals into defensives, and defensives are a much better place to be at this point. And they haven't even gotten expensive yet. Like when I take a look at those areas of the market, they're not trading at a premium to the overall index. And generally, when the pendulum's going to come back the other way, those types of sectors tend to trade at premium. So I think you have to really stick with quality just to make sure that you don't get kind of whipsawed on this whole thing. And I think yield is really interesting because you still have this incredible carry that you can pick up in certain segments of the markets. High yield is another one. Yeah, credit spreads have come back in again, but the overall spread level, I mean, you can get something north of 7.5%. You just can't find that in that many places, and it's really attractive to a lot of types of investors, especially with the advent of so many boomers retiring at this point, right? Like there is a huge, insatiable demand for income, and we see that. So we have an income product as well. It's predominantly sold in Asia, and they record flows every single year, right? It's unstoppable at this point. So I would just say that that's probably like a big theme for us, and when we're thinking about our portfolios, is where can I get income that I'm not going to find it in the regular traditional places. So just be careful on that low vol move, though. Do not get caught out in that, my friends.
That'll get you. The ones that we've seen a lot too is it's low volatility until it's not. Also, especially with some of these arguably problematic rent-seeking companies, especially, we talk a little bit about the healthcare, you mentioned kind of some of the healthcare issues. There are definitely pockets where you got to be careful in some of those. But at this point, I'd like to open it up for the audience for any questions from you all. Yeah, one?
Question for the panel. Has your view on gold changed this year?
Alessio, we'll start with you. Dollar depreciation.
So we have seen this year. Okay, let me take a step back. The two main drivers to gold, and as asset allocators, we always think about how am I funding that position, right? We never think in outright terms. We always think relative. There's always an opportunity cost. We think about gold funded 120% from fixed income and allows us to barbell. The diversification benefits from gold allow us to put an overweighting to equities to a risk neutral portfolio construction, right? Basically, that gold position, the diversification benefits allow me to add risk back in another part of the portfolio. When I think about gold basically predominantly funded from fixed income, you're trading two defensive assets for each other, right? So it tends to do well when you have expectations at the same time for dollar depreciation and overall a high volatility market. So we're not in a recession, but our models arguably way too early put us into what we call a contraction regime back in July of last year, growth below trend and growth expectations deteriorating. Obviously, we were too early on that across most asset classes, felt more validated more recently. So gold is performing actually, the outright returns in gold look on steroids, but when you contextualize it historically with analogous regimes of combination of weak growth dynamics and dollar underperformance, it's actually in line.
Alex, I know we were talking a little bit before about Jay Powell's press conference today, and I know the Federal Reserve has often been seen as the sign, whichever way they go, gold goes. So maybe talk a little bit about if you have any opinion on that thesis, and then maybe how the Fed's current stance might influence gold.
As an income-oriented investor, gold doesn't really play a role in that world because you still can't find a way for it to generate income, without some financial engineering there. I personally have always thought the idea that it should be the price of a well-tailored men's suit for 1 ounce. It kind of works back. You can go back. It works to at least 1000 AD in terms of timing. And if anybody's checked prices of well-tailored men's suits in New York these days, it's still about the right price, even though it's up a whole bunch. So I do feel like it's probably the case that if you're worried about the supply-demand picture for treasuries and you want an alternative asset for your diversification, you can see why it would have done well, especially if you're measuring it in dollar terms, with the dollar weakness in international demand. I think with respect to the Fed, I don't see them as being a big driver of the gold situation. I think that's more to do with worries about the dollar and worries about administration behaviors. I think with the Fed, they've been super clear, really since the March press conference, that if you want to know what's going to happen, go talk to the administration. We're not the drivers here. I counted in the first 45 minutes of today's press conference, Jay Powell said the word wait 24 times. Said, we got to wait, see what happens with the data, see what happens, right? So they're not, I don't feel like they're driving things, whether it's gold or the overall economic outlook. Generally, we measure how much extra volatility is expected in the market on a day when there's a big news event, whether it's the Fed or inflation reporting or something else. And for this meeting, the extra volatility was 1/4 what we would expect for a normal Fed meeting. It's just not where the news is right now.
Barbara, any further comments on gold?
I personally, we do not invest in gold. So predominantly the funds that I manage are for retirement or model portfolios. We don't have gold in them. I can't necessarily make it work, right? For our portfolios, and we kicked commodities out in 2017, which still feels like a good decision. And I think gold gets really also driven by retail demand too, right? But I think there are some questions over here too.
Yeah, I was just curious. I'd love to hear on the panel if they think the next Fed chair is going to be Jay Powell's term ends in 2026, and what does that mean for Fed dividends?
Barbara,
So I think the runner-up at this
is Kevin Warsh, right? Just from everything that I've read. I'm sure there will be others that will be brought into the administration, but he was brought in for Treasury. He was in the running when it was Jay Powell. His wife's family is very connected to the Trumps, so that wouldn't necessarily be a bad bet, I think, probably at this point. I've seen him speak a number of times. He really does seem to probably have more independence than maybe what the market's going to give him for at this point because of that personal connection. But that would probably be my, if I had to take my rookie guess, that would be it.
I agree. Front runner. I agree he's the front runner. And what we've seen in the past with administration appointments is that the requirements from the president can be different than what the market necessarily wants to focus on. But I think for this particular office, that the Senate will require something that is market palatable. So there'll probably be more noise about Fed independence, but I'm not sure there'll be more actual change. I do think that leads to the possibility of investors requiring a higher yield to lend money to the U.S. government, though.
I think we had another, this.
So the Trump put, you talked earlier about it being linked to, so is it linked to bond yields? Is the Trump put linked to labor, employment? Is it linked to the stock market as it was in the first Trump term? Or is there even a Trump put, or are we just putting ourselves on?
I think there's the best input, right? So I think when, you read the article in the journal, they waited for Peter Navarro to leave the room, invest it, and Lutnick went in. Now I have another story that Lutnick was actually in the original writing of the tariffs. So I'm not sure which way we're saying, but the fixed income market was the final arbiter, which made the president back down. And that was because I think he had a very smart Treasury Secretary that saw what was going on in the funding markets. And when it's self-inflicted like that, it's difficult to say. I mean, the Fed rode to the rescue in the pandemic, saying, look, nobody caused this issue. We're going to come in and support the high yield bond market. Smart thing to do. I don't know that the Fed can do that at this time. So I think Fessig was very sensitive to the rise in yield that was happening and could see a very nasty scenario unfolding. So I would say it was more of a treasury put than anything else.
The evidence would suggest that it's 37,500 on the Dow. No, I'm totally serious, and I don't mean that that's not an investment input into our process. But if you just look at public statements, either on social media or elsewhere, the Dow is what he looks at. He's not an S&P guy; he's a Dow guy, and that is the number. When it gets to 38, both times it's gotten there, something's happened. Now, one of the times it got there happened to have overlapped with that morning when funding wasn't that great. And I totally agree with you that for some parts of the administration, I won't say whether they're the adults in the room or not, they are focused on those funding markets. But he is definitely watching that, at least in the context of wanting to say things once he sees those levels. He's been pretty explicit that he was explained to him that there would be some pain in the equity market, and he seemed very happy to take that initially. Later on, not so much.
Well, let's see, any opinion on the put strike price?
Now I want to know what that 37 whatever number on the Dow. Who watches the Dow, by the way? I don't know if it coincides with a special day in the administration, kind of like a break-even number. No, I don't have any other comment.
What other questions do we have? Yes.
Any calls on the new vote?
Well, being from Rome, I'm taking that one. I am from Rome, but I don't have any opinion. No.
Do you think anything other than getting the stick out of the spoke bike comes from trade-related tariff negotiations? I was thinking about, for example, agriculture in Europe, angry French farmers. That's a domestic political situation that is not something that's movable from my perspective.
I know Alessio spoke about this before we came on.
And I missed the earlier part of the question. So,
other than self-inflicted, arguing with yourself, the administration, does any tangible changes
As we were mentioning earlier, I think with certain bilateral relationships, I completely agree with Barbara. When you say Japan, I think the ability and willingness to negotiate and get to places is really there. Same thing with Canada and Mexico, although the modus operandi is questionable. I think the Canadians are really, really far more upset than is understood. That is really potentially permanent damage. But with Europe, there are certain sectors, certain industries where I think the gap is not movable. Food, pharma, and data protection, concerns around consumer protection, around big tech, right? Expecting Europe to deregulate big tech in Europe, not happening. Food, not happening. Pharma, not happening. Cars, luxury goods, maybe other non-controversial exports, sure.
I think that there is definitely the possibility for changes, and some of them will probably be net good for the U.S. and for global economic trade, because there definitely have been parts of the world or particular countries where people have taken advantage of the relative sizes of different countries and their willingness to overlook things. So a world where there's more ability to have trade with India on even playing fields for the rest of the world would be, I think, fantastic for everybody, both people inside of India and outside. So I think there is the possibility. Part of your question, though, I think gets to a really key element to the timing of this whole thing. There are domestic political considerations on the other side. Part of the reason that Mexico was able to negotiate much quicker than Canada was because they just had an election. Canada was in the middle of an election campaign. You cannot negotiate with someone who said that you're going to be a state while you're trying to get elected. And similar in Europe, there's so many domestic considerations in different countries that it's going to take a lot more time. And it's not clear to me that everybody's appreciating that the other side's other constituents in some of these conversations, but I see no reason why there can't be some positives out of this too.
One last question, and then we'll run, is, because I know there's an Uber waiting for you guys, but you manage teams as well, and you allocate resources, human resources, technical resources, research resources. If you had one place to allocate more resources over the next year, and Barbara, I'm going to start with you. What area are you looking to invest in to improve your organization or improve your knowledge and capabilities?
I think the single biggest investment you can make on an investment team is your people, right? People are only as good as the direction that they get from their leaders, from their objectives, and from their managers and their mission. Our team is focused on two things. We invest assets for retirement outcomes, and we invest assets for college education outcomes. The team feels a tremendous amount of purpose and pride in doing that. Every year, I bring in a family from one of the states we run the 529 plans for, and they talk about how they're saving to send their kid to college and how we're making it easier. And I do the same thing with one of our plan sponsors. I bring in, somebody from like the line at one of our major energy companies where we're the target date manager for their E&P operations. And we bring them into New York, we have them come in, we talk to the team, we show them the whole offices, we take them to dinner. And I think when you have purpose, right, if your employees and your teams and the people that you're managing don't know why that they're doing their job, fix that. Because that is the single biggest driver to have somebody staying late at night to finish up a project or reading a investment journal on the weekend or going the extra mile when they feel purpose for what they're doing. It may sound very squishy, it may sound very kind of up in the air, but I run a lot of investment teams. Purpose is a big driver for it.
I don't believe that anything you do is squishy, Barbara. I think it's all with strong purpose. Totally agree with you in terms of what's most important for us in terms of incremental for the next 12 months. It's all about new data. The quality of the surveys is deteriorating with the official data just because of people's changing social mores. Nobody answers the phone anymore. People behave differently on when it's switched online. So just getting alternative ways of understanding what the economic state of play is probably the biggest place in terms of incremental allocation. Obviously, people are number one, but in terms of the incremental.
Yeah, 100%. Probably legit.
People are number one, and you hire the smartest people, they're going to make the best decisions. Where I think, given the nature of our industry and how it's evolved, it's really about barbelling your investments into two areas: automation and scalability. In our case, it's all about incremental customization. How do you, and only through very thoughtful automation that marries the integrity of an investment process with all the levels of customizations that we're required to deliver, we launched something like 7 to 10 new portfolios per month. And everybody, now it's like Starbucks. Everybody wants something different, right? And how do you deliver that? That's where the market is and where it's going to continue to go. How do you deliver that level of fine customization without compromising the integrity of your investment process? So design an investment process that is scalable, modular, and invest in that automation. The other barbell, you have to have top quality client servicing people. The delivery of that message, the quality of that client service has never been more important.
I couldn't agree more. How about a round of applause for all of our panelists? Thank you.